Okay, look, it's April 20th, a date that for some reason Elon Musk finds really funny. 420 is a pot smoking reference that in the real world isn't funny, but it's really hilarious if you're either a 15-year-old boy or a tech billionaire. The only thing funnier than 420 to people like this is, of course, the number 69. Look, I don't know, I guess I'm telling you this because I'm recording this video, obviously, on April 20th, and it's about Elon Musk's whimsical attempt to buy Twitter. And I guess I'm just trying to warn you that this video could be really dumb. Now, I probably should Google 420 and tell you guys a little bit more about it, but I don't really need to do that as the comment section will be filled with hundreds of comments starting with the word actually. And in truth, I really don't want to know much about it because I worry that if I fill my head up with nonsense like this, that there's a risk that it'll push out some actually useful information and my channel will eventually degrade into me discussing the genius of using rocket technology to build tunnels, which would likely make the channel a lot more popular.
So we get to use rocket technology to build tunnels.
But my overall goal with this is to forget having made this video almost as soon as it's uploaded, and I'll probably do that by listening to Razzle Khan music on repeat play until I've forgotten pretty much everything, and then I can get back to my longer term goal of having a YouTube channel that's mostly about rap and, of course, rapping.
Who got coronavirus? Who got coronavirus?
The real struggle here is that trying to apply financial norms to Elon Musk's proposed takeover of Twitter is truly pointless. And I guess before digging into this story, I'm trying to warn viewers that if you don't know about why he finds 420 funny, and if you don't know about his possibly jokey offer to buy Twitter for $54.20 per share, maybe watching a different video is a good idea. The world might make more sense to you if you never hear about any of this stuff. So anyhow, you've been warned. Over the last few weeks, Elon Musk, the inventor of the light bulb and the tunnel, disclosed that he had bought a major stake in Twitter, agreed to join its board, reversed that decision, and then launched a bid to take the company private. His offer values the company at $43.4 billion, but he acknowledged that his offer to take Twitter private may fail. Now, Elon, of course, does occasionally like to pretend that he will do mergers and acquisitions because he's bored, and he usually makes such announcements on Twitter. He spent around 3 weeks back in 2018 pretending that he was going to take Tesla private at $420 per share, later claiming that this was a joke and settling fraud charges with the SEC. But of late, he has started claiming that it was not a joke. It's really hard to know what to make of this. Musk announced his bid to buy Twitter last Thursday in a filing with the SEC, in which he said that he would unlock the company's potential to be the platform for free speech around the globe. I think that what he means by this is that once he owns Twitter, he'll be able to achieve his childhood dream of getting to call whoever he wants a pedo. And who are we to question the dreams of the man who invented video games and Twizzlers? He announced on Twitter that he would endeavor to keep as many shareholders in the new privatized Twitter as is allowed by law, insisting that he did not want to monopolize or maximize his Twitter ownership. So I guess he wants to buy the whole company and keep it owned by the shareholders, which is a bit of a confusing idea, but anyhow. When Musk, the inventor of the battery and the electric toothbrush, was pretending to take Tesla private back in 2018, he similarly stated that he was going to let all of Tesla's existing shareholders remain shareholders in the new private Tesla. This, of course, made no sense at the time, and it makes no sense today. It's amazing that the man who invented the autonomous vacuum cleaner and penicillin would put forth a plan that makes so little sense as this. In his typically understated fashion in an interview at a TED conference, he described his bid as being a benefit to humanity. Civilizational risk is decreased the more we can increase the trust of Twitter as a public platform, he said. So yeah. Now, we must keep in mind that reducing civilizational risk is of great importance to Musk, the inventor of the space shuttle, as if he saves civilization through his purchase of a website, he might not need to move to Mars, as he appears to be planning, where the average temperature is around minus 80 degrees. Now, some of you are probably wondering if that's minus 80 degrees Celsius or Fahrenheit, and it doesn't actually matter. It's minus 80 degrees, and there's no coat that will keep you warm in such a situation. If Musk can save civilization by owning a social media company, he avoids living the rest of his life in a freezing underground bunker on a distant planet. So you can see why this matters to him. Now, he also announced that he doesn't care about the economics of the deal at all, adding that he has a plan B if the bid is not successful. The stock price fell 1.7% on the day of his announcement to $45.08, implying that the market puts lower odds on Musk buying Twitter after his formal announcement than it did before the announcement took place. I'm guessing his plan B is the underground bunker on Mars, but feel free to let me know what you think it might be in the comments section below. So is this even a serious offer? Well, Florida man, Governor Ron DeSantis, seems to think that it is. He's threatening to go after Twitter's board of directors, saying that the firm fumbled its fiduciary duty by trying to scuttle a sale of the company's stock at a premium. But company boards are not actually obliged to just accept every bid that comes in above the current share price, or to even let the shareholders decide. The way corporate law works is that if the board decides in good faith that keeping the company independent and executing management's existing business plan will be worth more to shareholders in the long run than Musk's stoner-themed offer, then they're allowed to decline the offer with no breach of fiduciary duty. Musk's $54.20 a share offer is, as he points out, at a premium to the price the shares were trading at when he started buying his stake a few months ago, but it's well below the levels the stock traded at quite recently. Its stock traded above $54.20 on most days last year, so $54.20 may not be seen as a tempting offer to many long-term shareholders, and many of them have come out and said that. As we know, Elon Musk, the inventor of tiramisu and the hair transplant, uses Twitter polls to make almost all of his important life decisions. And so he, of course, tweeted a poll asking if taking Twitter private at 54.20 should be up to shareholders or the board. And the good people of Twitter voted that it should be up to shareholders. Now, there is, of course, a way of letting shareholders make this decision. A buyer could launch a tender offer, which goes directly to the shareholders and doesn't technically have to be approved by the board, even though they usually are. If the shareholders agree to sell their stock at that price, the deal gets done. But this is not what Elon Musk, the inventor of teenage angst and roll-on deodorant, did. He instead sent a vague, non-binding letter to the company with a purchase price that's designed to make stoners laugh. Now, as I said, most tender offers do get board approval first, and this is because boards can usually block a hostile tender offer by implementing a poison pill, which is just what Twitter has done, and I'll explain how those things work in just a moment. Now, a big question that we're seeing in the press right now is whether Musk can actually secure the financing to do a deal like this or not. The price action in the stock implies that market participants are not really taking this deal seriously and that they don't believe he can close the deal. When he was asked at the TED conference if he had funding secured, he replied, "I have sufficient assets." And what that basically means is no. He's not pretending to have financing in place this time. His offer is contingent on completion of anticipated financing and due diligence. What that means is that there are many ways that he could back out of this deal. If the market thought the deal was likely to go through, the stock would be trading much closer to the bid price. If the market believed that another buyer might step in, the stock would be trading above the bid price. Right now, investors are not getting involved, as it's just as likely that he dumps his shares as that he tries to complete a deal. A lot of people will say that Musk, the inventor of underground taxis and underground traffic jams, is a wealthy man and he can simply finance the purchase himself. After all, he is worth $260 billion on paper, and he only needs to come up with around $40 billion to buy the rest of Twitter at $54.20 per share. The most straightforward way for him to do this would be to sell some of his stake in Tesla and SpaceX. The downside of doing this, of course, would be the hefty tax bill generated by those sales. He would need to sell more than $50 billion of Tesla stock to get $40 billion in cash, as he would need additional funds to pay the capital gains taxes. This would likely push down the price of Tesla stock, both because of the large stock sale, but more so because it would signal to the market that he had lost interest in Tesla and was moving on to focus on Twitter. You could see it as being a bit like the way he appeared to lose interest in Grimes when the Tesla bot showed up. Now, another way to raise the money would be to pledge his Tesla shares in return for a multi-billion-dollar margin loan, which he could then use to do the deal. But unfortunately, he's already pledged over half of his Tesla shares for loans and is capped by Tesla as to how many shares he can pledge in total. The reason for this limit is to reduce the risk for Tesla that a dip in the stock price would trigger a margin call, which would then cause a big liquidation of Tesla stock. He could possibly push Tesla to change this rule if he wanted to, though. Another problem with using his stock to collateralize a multi-billion-dollar loan is that most banks would be nervous about taking Tesla shares as collateral due to the volatility of the stock, which is actually more volatile than Bitcoin. It's also a very expensive stock, meaning that it could fall a lot, making it very unattractive as collateral for a lender. When you add in Musk's reputation as a loose cannon, it's unlikely that he could do a deal this way. Now, other things he could do, though, is to get backing from a buyout firm. But once again, it's not obvious that they would want to get involved in a deal like this, where Musk has already announced that he doesn't care about the economics at all. If Musk was running Twitter, he would likely be making all of the decisions and not making them with a focus on maximizing cash flow, which would matter to a buyout firm. The Wall Street Journal reported on Monday that Apollo Global was considering investing along with Musk in a potential deal. However, Apollo is apparently only considering providing debt or preferred equity funding rather than equity. One more approach would be to use Twitter's debt capacity to get financing from banks. But Twitter's cash flow from operations last year was about $632 million, which is just not going to support anywhere close to the debt required for a takeover. Okay, so that's the financing. Now, we know that Twitter implemented a poison pill a few days ago, so what does that mean? Well, poison pills are a takeover defense strategy whose technical name is a shareholder rights plan, and it's an idea that was invented in the 1980s, but not by Elon Musk. Poison pills are pitched as a strategy to protect shareholders from corporate raiders. So you might ask, why would shareholders want to be protected from someone who wants to buy their shares from them at a premium? Well, there are all sorts of buyout strategies that exist that might not treat all shareholders fairly. A corporate raider might, for example, buy up more than half of the shares of a company in a tender offer, swap out the board of directors for some of their cronies, and then propose a merger at a much lower price, which gets approved by this new board of directors, and the remaining shareholders are forced to transact at that unfavorable price. This is known as a two-tier tender offer. Corporate raiders sometimes even threaten to do things like this, and shareholders then cave into their demands, accepting a low initial price to avoid getting a much lower price if they stay on as minority shareholders. To a certain extent, Musk is already threatening Twitter shareholders by saying that $54.20 is his highest offer price and that he might dump his 10% stake if the deal does not go through. We should note that a chunk of Musk's stock purchases were done illegally. He was required to disclose his ownership stake by March 24th, but didn't disclose it until April 4th. And then he claimed to be a passive investor at that point. This delay allowed him to buy an extra 13 million shares at a lower price than he would have paid had he announced on time, and this saved him and cost the shareholders who sold as much as $150 million. Twitter can quite reasonably argue that the poison pill that they've put in place protects existing shareholders from being tricked by this type of unlawful secret stock accumulation that Musk has already been seen to engage in. Now, the way poison pills usually work is that a rule is passed that if a buyer acquires more than a certain percentage of the company's stock, then the company is able to dilute that buyer's ownership stake. They do this by allowing all of the other shareholders of the company to buy more shares either at a discount or by simply giving all of the shareholders, other than the corporate raider, more shares for free. So if, for example, anyone builds a stake of, let's say, 15% of the company's stock, the company then distributes one free share of stock for each existing share, except to the person who went above 15%. So everyone else's share count gets doubled, knocking the raider's percentage stake of ownership down to 7.5%. There's no limit on how often the company can do this, meaning that the raider is forced to negotiate with the board of the company if they're planning a takeover. Now, this, of course, sounds a bit strange and a bit unfair, so obviously it was controversial when first implemented. And when something is controversial, there's usually a lawsuit. The Delaware Supreme Court approved this tactic in a 1985 decision, noting that the board's reason for the adoption of the rights plan was in reaction to a perceived threat in the marketplace of coercive two-tier tender offers. It was decided that drastic measures like the poison pill are justified in such cases to block coercive takeover tactics. In the case of Twitter, if Musk or anyone else acquires more than 15% of Twitter's stock, then every other Twitter shareholder will have the right to pay $210 to acquire $420 worth of Twitter stock at whatever the market price is at the time. Do you see what they did there? It's a pot smoker joke, because in defending against Musk, it's important to be as dumb as Musk. You have to understand that there will have been lawyers who had to sit there in a meeting and listen to a snickering Twitter executive insisting that the number 420 be forced into the deal. The lawyer will have said, yeah, I'll put that in. They can buy shares at a 50% discount. And the Twitter executive will have said, no, you have to put in the number 420. It's the only way we'll be taken seriously by idiots. I truly feel that lawyer's pain. Anyhow, if triggered, the poison pill will both destroy the value of Musk's stake and dilute his votes. In the 1980s, a lot of companies put poison pills in place, whether someone was trying to buy up the shares or not. Today, they're generally only used to protect against corporate raiders, and they generally have short expiration dates. They're not considered great corporate governance. In March 2020, when the stock market fell quite a lot at the start of the COVID pandemic, a lot of poison pills were quickly put in place by companies who worried that hedge funds would exploit the market crash by taking big positions in their stocks and attempt takeovers on the cheap. Twitter's rights plan expires in 1 year's time. I guess they could have had it expire in 420 days. They possibly missed a bit of a trick there. So as of right now, there's a bit of a stalemate between Twitter and Elon Musk, the founder of PayPal and Tesla. The Twitter board has managed to get some breathing space and can consider this bid and possibly try and find additional bidders in the open market. The poison pill will encourage Musk to negotiate with the board and to demonstrate that he has financing lined up. Essentially, he'll have to show that this whole thing is not an elaborate April Fool's Day joke. Musk is left with two main options. He can negotiate with the board and try to strike a friendly deal, or he can pressure the board into dropping the pill with a tender offer and a proxy fight. Right now, he's hinting that he'll take the second approach. A tender offer is a public binding document filed with the SEC, which is available to all shareholders. It discloses the buyer's plans and, most importantly in this case, their financing. Shareholders, if they like the deal, can then tender into this offer. Now, Musk won't be able to buy the shares right away, as the tender offer would be contingent on getting rid of the poison pill. But if enough shareholders tendered into this offer, the board would likely go along with them and get rid of the poison pill. If Musk negotiates a merger with the board, it allows the board to insist on protections for all of the shareholders. They can require that shareholders be given a choice of cash or stock in the new private company, and that there'll be enough funding in place so that if all shareholders elected for cash, that they would get it. The board can still, of course, just say no to Musk, but that's unlikely, as shareholders would possibly be upset with them and the stock price would likely fall. But it is still within the range of possibilities, and if they did do this, a court would be unlikely to intervene. Anyhow, if you enjoyed this video, it's mostly based on my corporate finance book. There's a link to it in the description below. For more on the topic of mergers and acquisitions and how they work and how they can be traded, you should watch my video on merger arbitrage next. See you soon. Bye.